Gloria, I think we have quorum. If we can start kindly.
All right.
Good morning, ladies and gentlemen. Thank you all for joining us for the 6th edition of the Enewealth Conversation. My name is Bansi Kaleli.
Bansi, we can't hear you.
Hello, good morning. Can you hear me now?
I can hear you, Bansi.
Great. Thanks, Simon. And thank you, ladies and gentlemen, for joining us. We are very excited to be engaging with you for the 6th time. The Enewealth Conversation is a partnership research initiative between Enewealth Financial Services, Strathmore University, and the Institute of Human Resource Management. We are very honored to be joined this time by RBA CEO, Mr. Nzomo Mutuku. I see him as one of the panelists who's logged in. Karibu sana, sir. We also have panelists from Strathmore University and Enewealth Financial Services. We'll later be joined by NSC CEO, Mr. Geoffrey Odundo, and we look forward to engaging with you. This study is on the effect of COVID-19 on the financial and general well-being of retirees. So we've seen a number of studies looking at how it's impacted the youth, how it's impacted the economy, but then we ask the question, how is it impacting the older ones in society? So before we get started, I want to invite Simon to just give his opening remarks. But before he does that, just some ground rules. Should you want to speak at any point, feel free to raise your hand. We'll give you opportunities in the course of the webinar to just ask your questions. However, in the meantime, you can use the Q&A platform and then also the chat function. So before I invite Simon, I'll just say a quick prayer, then we can get started. So let's believe and pray. Heavenly Father, we praise you for another day that you've enabled us to just congregate from very different locations and learn from one another. We pray that you may give us open minds, that this study, the insights that we get will not only be, a textbook or just theories in our minds, but there'll be something that we can implement for the better of our future and even that of society. In Jesus' name we pray, amen. All right, karibu sana Simon for your opening remarks.
Thank you so much, Bansi. Since my video cannot start, so I'll just talk as it is. A warm welcome to all the attendees on this virtual webinar. Today we discuss about the impact of COVID-19 on the retirement well-being, and we are extremely honored and privileged to have the CEO of the Retirement Benefits Authority, Mr. Nzomo Mutuku, who is one of our chief guests on this virtual webinar. Enewealth Financial Services remains committed to undertake social security research, and this we do in partnership with Strathmore University. The outcome of these research findings we often share on the platform we call Enewealth Conversations, and this is the 6th one. A lot of thought-provoking, enlightening conversations arise out of these research findings. We are looking forward to an engaging session, and I think stay on. If you can invite your colleague who hasn't joined, I will be glad that you would alert them that we have begun the webinar. Towards the end of the session, we're going to have an interactive session where you can be able to ask questions and answers, and we'll be happy to respond to them. Meanwhile, I think our technical team, if you can do something around enabling video to be shown, it will be helpful. Back to you, Bansi. Thank you.
Many thanks, Simon, for that introduction. Before we get started, I have a quick poll. We'd like to also hear and engage with you, the attendees. So you'll see a poll question on your screen. And just to let you know that I have goodies for 10 of you, which will be issued in the course of the session. So please feel free to participate and could walk away with something. So the first poll should be on your screen. We'd want to know, even before we get started on this webinar, what areas of your life or facets of your life have been most affected by the pandemic? It could be your finances, maybe there are more, maybe you've had a reduction, it could be your physical health, probably you contracted COVID. It could be social interactions, probably you can't attend church or your place of worship. Could be travel, could be work. Some of us haven't gone to work since last year, March. And then it could be your mental health as well. Probably you're finding the period to be very stressful and it's affecting your mental health. So I'll run the poll for a minute. We have around 20 seconds left. I see half of us have done the question. So just give us your response so that you can compare your feedback with that of the retirees and see whether there's a tally in terms of how COVID is impacting our day-to-day life. 10 seconds left. And we are up. So I'll end the poll and launch the results. You should see them on your screens. It's very interesting that for this group, 62% of us, the area that is most affected is our social interactions, followed by finances, then travel, working environment, we're working from home, physical health is a list, thankfully. Mental health comes just above physical health. Thanks for your responses. I'll then launch a second poll on your screens. And we asked the retirees, other than just your general well-being, how are your expenses and your finances being impacted by the pandemic? So please rate, what is your top expenditure item since the pandemic hit? You can only choose one. So it could be school fees, it could be medical costs, it could be food and housing expenses now that the children have been home for quite a long time. It could be social events, harambes, to just take care of emerging needs, and then support to other family members. It could be that some people are retrenched in your household or lost their jobs. So it means that you have to support a lot more people with the same amount of money that you had previously. So just give us your responses. I see, yeah, close to half of us have answered. I'll give us another 15 seconds to just answer this, and then we'll compare with what we got from the study. Okay, the results are on the screen. It looks like we are eating more and pushing a lot more of our expenses around household expenses, which is totally understood now that we have a lot more people in the house and a lot more time in the house, especially if you're working from home. So thanks for your feedback. I think there's a correlation, and I'll invite Lydia, who will take us through the first session, just giving us a background of the study and what were the objectives, and then we'll get into the meat of the session. Karibu, Lydia.
Thank you, Bansi. I'd just love to start by saying that our vision as Enewealth Financial Services is a lifetime of financial well-being and dignity. And this speaks to the very core of what pension is all about. That pension is about a promise of opportunity. It's also about a promise of financial well-being, and it's also about a promise of dignity in retirement. And the most accurate way to actually measure this is by looking at the quality of lives of retirees in a particular jurisdiction and see how they are doing in terms of their medical well-being, in terms of just having finances to be able to purchase. As of now, our income replacement ratio is at 35% as compared to what is the recommendation globally of 70 to 80%. And the pandemic era has actually emphasized the need to develop very elaborate and dynamic pension systems that can well respond to extreme scenarios in terms of the shock on the economy and also the effect of lifestyles of people over time, and especially the senior citizens. I'd like to invite Naomi to take us through the second slide on the research objectives. Welcome, Naomi.
Okay, thank you very much, Lydia. Please let me know if my audio is good enough.
Naomi, your audio is not very loud. You may increase it a bit and make it audible.
Okay. Is that better now?
Yes, thank you. And carry on.
Okay.
Even though we would have loved to see you.
Yes, I cannot put on my video. The host has disabled.
Okay, let's carry on. Sorry.
Yes. If Gloria Obansi can enable my video, I'm okay. All right. So as Lydia has explained, Enewealth is concerned about improving the life of retirees as they retire, okay, before and after retirement. So in conjunction with Strathmore, Enewealth has carried a number of studies to study this phenomenon or to try and understand what is it that retirees are looking for after retirement. And so this is one of the studies that we carried out. And because of the COVID-19 effect, we sought to look at the financial and general well-being of the retirees in Kenya. And there were three specific objectives that you were looking at. The first one is the financial well-being of retirees in Kenya, how well they are doing in terms of healthcare and mental well-being. And we had a question on the level of satisfaction of life of these retirees. So, go to the next slide. We administered the questionnaires to people who had retired within the last 1 year when the COVID effect or the COVID pandemic was in full effect. And we sent questionnaires to these retirees, and we got 168 valid responses. This was a descriptive research as you were trying to describe what the retirees were going through. Next slide, please. And so these were the research findings. First of all, based on a demographic aspect, the ratio of male to female, of the respondents, 35% were male, 65% were female. Next. And then this was the age group. Yeah, so we were trying to analyze and see what is the age group of those people who have retired in the past 1 year. As you'll see in a couple of slides, the respondents included people who underwent through voluntary retirement. That is why we have a category of respondents under 50 years. But the majority of people, as you can see, were above 55 years when they undertook retirement. So then the work sector, we looked at the work sector. There was a balance between the private and the public sector because public was 50%, the private sector was 47%, and we had a small percentage of people who had been working in the non-governmental organizations. Next, Lydia.
So we asked the respondents, how many people are in your household? This question wanted to, with this question, we wanted to understand how many people are the respondents supporting currently in their household. And you can see from this presentation, a majority of the people, more than 75% of the respondents had more than 4 people in their household. Yeah, they had more than 4 people in their household, and this corresponds to a census done by the Kenya National Bureau of Standards about the average number, the household size of that is 3.9%. But what is more interesting is that even as people retired, they still had 4 to more than 12 people they were supporting. So this shows they still have a large number of people depending on them, yeah, despite the fact that they will not have an employment income. And this you will see how it feeds into the research later on in a couple of questions, because you'll see that based on the questions we asked the respondents, they have to look for additional sources of income, yeah, apart from their pension. Then the next question was reasons for retirement. 59% of the respondents said they attained the mandatory retirement age. And then we had another category, 21%, who undertook voluntary retirement before attaining the retirement age, and then another 15% who were retrenched by the organization. We had a small percentage who retired to health reasons and other reasons. I would like to talk about the category of respondents who undertook voluntary retirement and were retrenched. Majority of these people indicated that they were asked to take up voluntary retirement by the organization, or they were retrenched by the organization because the organization was undergoing an economic downturn or negative effects in terms of their business, yeah, and therefore they could no longer support their employees. So they asked their employees to either undertake voluntary retirement or they were retrenched. And if you see the reports that have been in the newspapers or even done by the Federation of Kenyan Employers, as many as 600 firms sent their workers home due to the COVID pandemic. They could not support their employees anymore. So this correlates with what we have been seeing in the market. Next. And then we wanted to find out if the people who had retired accessed the retirement benefits, and as you can see, 90% of the people accessed their retirement benefits, and many of them belonged to a pension fund, yeah, in that they could access the money at some point during their retirement. So majority of them belonged to a pension scheme as opposed to a provident scheme. Next. And then we asked them, what amount of retirement benefits did you access? Majority of the respondents accessed a third of the benefits. Yeah, as you can see, almost 80% of them accessed partly their benefits, and this was 33% of their benefits.
And then we asked them what happened to the amount that remained in the scheme. Up to 60% purchased an income drawdown. Less than 10% purchased an annuity, and about 30% deferred the amount in the scheme. So we see the uptake of income drawdowns kind of schemes as opposed to annuities or deferring the amount in the scheme. Next. And then we asked the respondents, so of the amount that we drew from the pension fund, what did you do with it? Did you invest it? And 68% of the respondents said they invested the funds that they had withdrawn from the pension scheme. And these are the kind of areas that they were investing in. Majority of them invested in farming, 30% in businesses, others built rental or commercial houses. Then another popular option was investing in money market funds, and even quite a good percentage, 15%, they built houses or repaired their houses. Yeah, so you can see those were the 5 top trending ways in which these retirees invested the money from their pension funds. So, and then we asked them, did you seek additional sources of income? Remember the question we had asked earlier about the number of dependents or the number of people in their households. Yeah, and you could see about 75% of the respondents had more than four people in their household. Yeah. So it means these people may be depending on them. Please go back here. And so how are they going to bridge the expenses that they require, or the expenses that are being incurred in their households? Yeah, I think you need to go back a few slides. The next one, please. Yes, additional sources of income. Sorry, Lydia, do you mind if I share the slides? I think we are a bit, if you don't mind, please allow me to share my screen, and then I will share the slides that I have that you can share. Okay, thank you. Sorry about that. Okay, so where did they have additional sources of income? Yeah, this was the question we asked the respondents. And 57% of the respondents indicated they had an additional sources of income. And this income was from rental income, farming, and business income. Yeah, these were the 3 top sources of income. So, and this correlates to the previous slide of how the pensioners where the pensioners are investing the pension funds. So from the investments, they're able to get additional income from their rentals, from farming, and from business income. Then there was another category here, the 4th category, consulting and lecturing. About 5% of the respondents indicated they have taken up additional work in consulting or lecturing. in order to raise this additional income. Then we asked the respondents which were their most common expenses, or which were their, okay, the question was to rank the expenses in priority and in order. So the first expense, or the expense with the highest priority, was education and school fees. And then household and food expenses, transport, yeah, and finally support to other family members. So you can see the retirees are still paying school fees for their dependents, yeah, because many of them have people who are still depending on them. And then there is food and household expenses. And as we have seen from the short poll we just conducted, yeah, food and household expenses are common or are important for most people. Then we asked the respondents, have you experienced an increase in expenses? Yeah, and they said yes. And most of the respondents indicated that their expenses had increased by 26 to 50%. Yeah, and then when this is the green area in the pie chart, and then the next highest category was 11 to 25%. So you can see that 78%, yeah, of the respondents indicated that their expenses had increased between 11 and 50%, by between 11 and 50%. And this is quite a huge expense, yeah. And this, even from the recent surveys done by other researchers, what is being reported, yeah, that the COVID-19 pandemic has affected people's expenses in various ways. We are working from home, so there is increased consumption of food. The cost of internet, school fees has gone up because schools have to comply with government COVID measures, and all these expenses are being passed down to the individuals. And even transport costs, yeah, because of the COVID measures, yeah, transport costs has necessarily gone up. So we wondered where the respondents were getting the additional money if they've not invested enough. So we asked them, have you taken a loan in the last 1 year? And 35% of the respondents said yes, that they had taken a loan in the last 1 year. And the most common source of these loans was the mobile apps. Yeah, and this you can relate very well because Safaricom made a statement that Kenyans are borrowing like 1 billion every day. There's a proliferation of mobile loan apps until central bank has had to regulate them. So this relates to what is happening to the general environment. Then the next option, yeah, 23% of those who had taken loans said that they had taken them from commercial banks. Then SACCOs and chamas, yeah, were the other two options. So based on this, in conclusion, we can say that COVID has actually hit the retirees, yeah, in various ways, and especially because of the increase in expenses and the fact that they have a higher they still have dependents. So even without a salary, they still have to keep covering these expenses for the people who are depending on them. So additional sources of income are important. And if these still does not cover their costs, then they take up loans. And then the issue of many people, or up to 1.7 million people, this is from the Kenya National Bureau of Statistics, the people who have been made redundant due to the outbreak of COVID-19. This affected many people, yeah. So, and this we can see from the research, because many people indicated, I was laid off by my organization because the business had gone down. I was asked to leave because the business was not as performing as well. So these are all things that people have had to grapple with during the last 1 year. Then there's the issue of medical bills. Yeah, one of the questions we asked the respondents was that, have you had to see a doctor in the last 1 year? And the respondents indicated an average of 2 times. And only 32% indicated that they had insurance to pay for their medical bills. 41% of the respondents indicated they had to pay cash. Yeah, and that is why maybe one of the major expenses was support to family members. Yeah, we know in our society and in our culture, once there's a medical bill, we all come together to help support or to do a harambe to support the person to pay the medical bill. So the issue of medical for retirees is a big issue, and we need to look at it. Then finally, there was the level of satisfaction. We asked the respondents a number of questions on a 6-point scale, where 1 was a very low satisfaction and 6 was a high level of satisfaction. The average was about 3.9, yeah, which indicated that an average, or they were satisfied some of the time. Yeah, and this could be because of various things. Yeah, and we know that apart from physical well-being, financial well-being also matters, social support, and all the components that make up a human person. All these things and what is going on, including the COVID-19 pandemic situation that we are in, contribute to the level of satisfaction towards life. And here we have an article from Thomson Reuters Foundation about the whole issue of violence, especially in the last 1 year during the COVID-19 pandemic. Yeah, these things happen in our families. They happen with our siblings, our children. Yeah, so, and all contribute towards satisfaction with life. So in summary, as Lydia had said, the issue of the income replacement ratio on retirement is important, and we have to continuously work towards ensuring that retirees can live a similar standard of life when they retire. And especially because in our African culture, the level of dependency does not change much even on retirement. Then the second thing is the medical bills, in order to be able to improve the level of satisfaction for the retirees. Thank you very much. Any questions? Over to you, Lydia.
Thank you. The questions will come at the end of the presentation.
Okay.
Yeah, maybe I just I could just speak a little bit into this. The reality of, maybe just leave that slide, Naomi, back on the screen.
Yes.
The
No
last
problem.
slide.
Okay.
Yeah. So one is that why retirees are getting into loans is because of cash. Then the need for cash. Liquidity is a big concern in retirement. And that's why we overemphasize on the need to have adequate income adequacy at retirement and push up the income replacement ratio to be able to sustainably meet the expenses at retirement for the financial well-being of members who have retired. But I think also it's important to notice that dependence ratio impacted by COVID has gone up. So obviously in an African setup, when dependency is high, it means even the little income that one has to share across within the close family members. And that still also goes back to the necessity around the issues of income adequacy. But one key thing that I also observe is that, and we are very grateful to the reforms by the Retirement Benefits Authority around health insurance for retirees. I think if we were to do a survey maybe 5 years or 10 years back, chances are that we may not have had 32% of retirees on healthcare insurance. I imagine that we are starting to see positive fruits around the legislative reforms through which we have many people now aware on the need to save and also have access to health insurance at retirement. So I just thought of adding into that even as we carry on in this conversation. Once again, for those of you who have joined, most welcome. And we're also very grateful to see that we have not only Kenyans on this virtual, I can notice that we have even participants from other countries within the continent of Africa, and that we are very grateful. Over to you, Lydia.
Thank you. Naomi, please allow me to share. Please confirm that you can see my screen.
Yes.
Okay.
Yes, you can see your screen.
Thank you. So under the discussions, we wanted to understand the policy and structural changes that governments have explored across the globe to accommodate the effect of COVID-19. And we started with the Kenyan market. And one thing that was very notable was the Tax Law Amendment Act of the 2020, which was effective 25th April 2020 to January of 2021, where the tax bands applicable to the pension receipts are capped to maximum rate of 25% from the previous rate of 30%, which is in effect right now. The tax bands were also made wider for the people who are accessing their pensions below the age of 50 years. For the first 288,000 at the point of access, they were paying 10%. For the next 200,000, they were paying 15%. For the next 200, they were paying 20%. And anything that was above the threshold of 688,000, they were paying 25%. For the retirees who are above 50, the ones who access their pension, for the first 400,000, they paid 10%. For the next 400,000, they paid 15%. For the next 400, they paid 20%. And anything that was above 1.2 million, they were paying 25%, as compared to now, which is anything above 1.6 M, they're actually paying a tax of 30%. In other markets, there were different responses by various governments, and there was one for reducing the level of contribution. Other governments opted to permit for early access of pensions or slightly more than what people are actually permitted to take, while other governments, as we will see in the next slide, actually increased their support. For the countries that reduced the level of contribution, we see Thailand and Indonesia. They provided additional funds by reducing the level of contribution payable to pension arrangements. And by saying that they provided additional funds is that they were making money available for people to spend by actually reducing the amount of pension that their citizens are contributing. We also see in Singapore that they scheduled for increase of contribution to happen, to be deferred up to January 2020. So in this season, there is no increase in pension contribution. And then for some of the countries that permitted early access of pension, also more than is normally permitted, we see Australia, that individuals would access their income up to 20,000 Australian dollars for those whose income had dropped by more than 20%. And for India, they allowed partial withdrawals, which was channeled towards COVID-19 treatment. For the governments that actually increased support to the older people, we see Australia, they did a mean-tested bonus. And by doing a mean-tested bonus, what we mean is that it implies payments were made for individuals who demonstrated that their income and their capital had actually gone below the specified limit in their country. And then for India, they did ex gratia payments, and by ex gratia, it implies that the government was making payments more or less as a favor, just from the point of moral obligation as opposed to legal obligation. Then in New Zealand, we see that the payments were made also with a doubling of the winter energy payment. They do a winter energy payment, but this time round for the older population, that winter energy payment was doubled. And then in Turkey, there was an increase of state pension that accompanied the benefits that the people were actually accessing. Naomi has gone over the summary of findings, but these were the key observations that we made. That one, there was an increase in the uptake of IDD based on the people that took the questionnaire, that above 60% had actually purchased an income drawdown fund, as opposed to an amount that was just slightly above 10% that had purchased an annuity. Then for the public and the private sector, we see that the retirement well-being was averagely the same, that uptake of pension is there in public sector and also in the private sector. They are not far off. We see in public sector, the pension uptake is at about 50%, and for the private sector is at about 47%. And that all comes to how one is planning, whether you're in public sector or in private sector. It's all about how well you're planning the finances and actually just being a part of pension. And then one big issue that even Simon has mentioned is income adequacy. It remains a big concern, and we can be able to feed into that by actually seeing that people are accessing loans even after retirement to be able to keep them afloat in this season. Just to go into the recommendations, the very first recommendation that came very clear from the study is tax framework. There needs to be a relook into the policy and the framework around taxation to just come up with new rules and guidelines that cushions the retirees. And this will just go a long way in ensuring that retirees at the point of retirement, they have a substantive retirement package and that they are not overburdened with tax. Because you realize also, the higher the tax, the lower the income replacement ratio. Cumulatively, it has an impact on the income replacement ratio. The other recommendation is just for the universal healthcare program to be fast-tracked so that it be able to benefit, especially the senior population, that people be able to actually access healthcare services that they need without any financial hardship. We have seen that during this season, NHIF was not necessarily coming in, especially for the people who suffered COVID. It was not covering that expense. So we need this program to be fast-tracked for it to benefit a number of people. Then also inclusive financial products in the market. And this is a call on stakeholders in the financial industry and not just the government to be innovative in coming up with inclusive financial products that just allows retirees to access funds. We see a lot of inclusivity when it comes to youth. There are a lot of programs that enable youth to access funds, whether it's to begin business or to do whatever they need to do, but there isn't much that has been done around just supporting the retirees and enabling them to access funds. And given that we want to tackle the issue of income adequacy, then this should be something that needs to be addressed, just having financial products that are inclusive of the older population. The other recommendation is actually having retirement circles to also enable access of funds for retirees, and just beyond encouraging the retirees to save and also allowing them to access loans quite easily at considerable rates, it also gives them a sense of belonging, because that will be a community of theirs, yeah? That people, when they retire, they have a retirement circle. And one of the biggest issues that retirees are dealing with is social capital. Their social lives are equally affected. So having them in a circle where they can also interact and maybe even share ideas, having a retirement circle would be a good idea. And then it would also help with CRB rating, because after retirement, there is still much more than retirees can do in terms of being present in board members, in terms of being present as consultants, or even in terms of being present as mentors. And negative CRB ratings, of course, would bar them from participating in these activities when they can actually be useful in the society, in just upping and increasing also the knowledge based on the years that they have had in work experience, years of work experience. The other thing is the embracement of post-retirement medical funds and also income drawdown fund. I've mentioned the issue of NHIF pulling out from supporting people who especially suffered COVID-19. So the issue of funding post-retirement medical funds should be embraced by schemes and also individuals, just to enable them to access quality medical services at retirement. And our mission and purpose here at Enewealth actually talks about economic empowerment through innovative and financial solutions. And I have to note that we have innovative solutions and we are available for consultation even after this presentation. Consultations can be done regarding the post-retirement medical fund that we have, and also our income drawdown fund, which has a cap. We have an endowment fund that actually cushions people who are in income drawdown so that they don't run down their fund before the sunset comes. The other recommendation is mandatory financial literacy programs. It would be nice to have financial literacy programs, especially with regards to pensions being inculcated in our educational curriculum, that young people can grow up knowing that a pension is good to be funded, for retirement. So it is nice to inculcate this in our educational programs at primary school levels, high school levels, university level, so that by the time people are graduating from the university, they're getting jobs. They're actually not just looking at spending, but also saving towards retirement. And it will also help with personal financial management lessons. The other thing also is training on agribusiness. We have seen that most retirees who invested, they've said to have invested in farming, and that needs to be looked into. Their training needs to be offered there, because if most of them are going there, then it would benefit them to go into agribusiness with knowledge with regards to that, which makes me actually wonder. It's one of the food security is one of the big four agenda. And out of this, we see that most of the retirees are in, and I was just wondering whether it means that actually retirees form the biggest chunk of just ensuring that the food security agenda is being driven as it should be. And then the last recommendation is an increased government support and also social welfare programs. There has been money that has been given previously to older people in our midst and also the retirees. They've been having some monies end month. I think they are able to access some of that amount. So if the government can increase state pension, that would be quite beneficial in just supporting the older generation and just ensuring that they have money to spend. Thank you so much. I'd like to hand it over to Bansi.
Yeah, perhaps just Lydia, just to add on and to emphasize.
Thank you.
We are practitioners in the sector, and from our practical experience, we've noted in the last 3 to 4 years, our income drawdown book has grown. We do primarily 2 funds. One has grown in 3 years to about 3.5 billion. And another one which is about 1.5 billion. So the optimal flexibility opportunity presented through income drawdown seemingly is the greatest advantage that is pushing more retirees to that. And of course, also entwined in that is the opportunity to integrate the split into healthcare premium funding through the IDD. So I think I saw a question on that. And on a light note, you know, Bansi, the other day I saw some gray hair here while I was in the lift, and then I had to check on my statement. Yeah, just to be able to check, it looks like I'm a potential IDD beneficiary and healthcare. So self-awareness and just cross-checking where you are at is a very huge point of reflection in the journey of financial well-being. And we always have this opportunity actually through our service providers in the market to be able to benefit from this. And then finally, I can see Jenny saying gray hair is a sign of wisdom. So possibly we are growing in wisdom. I have kept noting that we keep also getting this request. Most retirees are saying, why can't we have a retirement circle to avoid borrowing from the mobile apps expensively? And then our monthly pension, maybe we build up some shares, and then against which we have ease and cheap credit. So I think it could be one area to be able to bring in some level of identity and cohesiveness, social capital, because identity is a big thing at retirement. So over to you, Bansi, so that we can get going.
Thank you, Simon. I think for your next birthday, I'll get you some dye for the white hair till you're ready for it. So we'll invite a few of the participants. If you have a question, we'd be more than happy to have a few of you speak. Just use the raise hand function and we'll take 2 questions before our next speaker, Mr. Jeff Odundo, begins his presentation. So just use the raise hand function and I'll allow 2 of you to react to the survey outcomes. I see Lucas, your hand is up. I've allowed you to speak. You can unmute yourself. Lucas Omondi. All right. Duncan Wasike, I've allowed you. Please go ahead and unmute yourself. Lucas Omondi and Duncan Wasike, are you with us? All right. Seems that the 2 gentlemen are not with us, but when they come back in, we'll allow them to respond and react to the findings. I see Godwin Otieno is asking us, do we have statistics on the uptake of AVC? I think there's need for more education on benefits of taking AVC as personnel head towards retirement. We agree with you fully, Godwin. This survey didn't cover whether or not they're taking up AVC. However, we are soon going to have a survey that focuses mainly on millennials and people who've just started employment. It will be interesting to see their views around AVC and even how they are planning to retire, how they are planning for their retirement. So with that further ado, I'll ask Lydia, please stop sharing your screen.
Yeah.
I see Mr. Jeff Odundo from NSE has joined us. Welcome, sir. You may
Yes.
go ahead and just dive into your session.
And thank you, Mercy. So a very great opportunity to have Jeff, who is the CEO of NSE, doing great work and creating value for investors. And institutional investors like retirement benefit schemes are actually key beneficiaries of what the NSE is doing. And Jeff, you know, now we have one of the participants is saying, welcome to the gray hair club. And I think then we will form a gray hair circle. I suspect you'll be one of the members. So welcome aboard, Jeff.
Okay, thank you. Simon, I'm really happy to be here. Just, if you don't mind, just give me 1 second and let me just adjust my camera properly.
Okay.
Okay, I hope I'm visible. Thank you.
Yes, you are.
All right, thank you very much. So I think once again, I'm happy to be in these conversations and just to congratulate Enewealth for your continued sensitization and engagement with your clients and even just the wider public. I think for me is to say that the NSC appreciates the pension sector, especially the administrators and also the trustees for the continued support that they continue to give the NSC in terms of participating in the market and helping in the growth and development of products and the capital market in general. My role today is basically to support this conversation. I've just heard about the questions around retirement. I'm happy to hear people asking about AVCs and how they can augment their retirement plans so that they can be able to really have a more accelerated or a more beneficial retirement arrangement when they get into the next life. I call it a continuation of the next career. So from the NSC side, our role is to support the growth and development of the capital markets in Kenya by providing an infrastructure that allows investors to access assets and also to issuers to really have those assets placed so that they can raise a capital or any other form of wealth creation they want to provide. So we have been at the very forefront of developing products and helping the market create opportunities for investors to access financial assets. So in the last, so to speak, 7 years, we have been focusing mainly on development of new products, just expanding the breadth of what the NSC has to offer. And today I'm proud to say that we offer about 7 different asset classes. I think historically we are known for just being a stock market, but today we are a securities market. So if you want to invest in bonds, if you want to invest in real estate, if you want to invest in assets like gold, if you want to invest in derivative contracts, all that is available at NSC through various products that we have created. We've also enhanced our infrastructure to enable people trade remotely. Last year, with the advent of COVID, we were able to take the market fully remote. The pension fund managers, the brokers were all able to execute trades from their homes. And that's been going very well. It was very seamless. So we are now at a new strategic direction. We are now in a new strategic plan, which enhances the growth and uptake of these products. And I just want to highlight what are the opportunities and the alternatives that we are now offering you. So our bonds market, our equity markets have been growing well, but I think we can still see more value if trustees can just look for these opportunities. Today, our equity market is trading at a multiple of less than 12 or 12.5 times. And that makes it a very undervalued market. And anybody looking for upside or capital gains, this is a good time to come in. And so we want to encourage you to do that. Having said that, the bond market has been doing very well. The government bond market has been very active. In fact, we're performing better than we did last year. And it's just been a renewed interest, especially from the local investors, both institutional and retail, and that's growing very, very well. Now, we are also focusing on alternatives. And one of the alternatives I would like to really highlight to investors is to look at what we call the real estate investment trust. Now, for a long time, pension funds have been investing in actual physical real estate. And this has its challenges. Now, one of the key challenges is the level of illiquidity of this asset. So if, for instance, a pension fund has invested, say, 30% or 40% in real estate, and they have a major exit of staff, to really liquidate that real estate becomes a challenge. So what happens? They actually liquidate what is easily liquid. And you'll find them selling their stocks or selling their bonds. Whereas when you want to pay out a big lump sum, it's good to actually take that from different asset classes. So property, equity, bonds, so that you reduce gradually. However, when you face that kind of challenge, then you look for your most liquid assets. Now, in a physical real estate, that becomes a bit of a challenge. And hence, there's a better case for trustees to consider investing in real estate investment trusts, which are just like equities. They're unitized arrangements. So what happens here? A promoter issues these units to the public, and then the investors buying those units, and they have still got then access to real estate because the underlying asset of these units are actually the real estate. So you enjoy the benefits of appreciation of the property, a consistent return, given that they have to pay a minimum return of 80% of rentals, net of fees. You enjoy the possibility of liquidity because they're tradable in the secondary market. And at the end of the day, you enjoy the benefit of a wide variety of assets. So if you go into a physical building, you buy one asset. But if you go into a real estate investment trust, you buy a portfolio of different assets. So one very good example we have is the Islam Fahari IREIT, which is actually there at the moment. And we're seeing more REITs coming into the market. So I want to encourage trustees to let's have a mind shift. Your real estate is a desirable investment. We do appreciate, but we have to change the way we do our real estate in the country and take that forward. The second one is exchange traded funds. Now, ETFs, again, these are units that are created off a basket of a portfolio. So a sponsor goes and buys, say, a basket of stocks, and that stocks, maybe it's based on the index. So you're buying stocks based on the NSE 20 or NSE 15, and you've taken different weightings based on the weighting of each stock on the index. And then you create units out of that. And those units are then tradable assets. It happens to be one of the most conservative investments because it tracks an index, for instance, or it tracks a certain asset class. And it also happens to be relatively cost effective. Now, at the exchange, we have an ETF that is whose underlying asset is gold. So last year, let me give you an example. The value of gold appreciated for 1,200 shillings to about 2,000 shillings. So anybody having a gold exposure was able to get the benefit of the upside of prices, because in a very volatile market, then gold becomes a good asset class, and hence that's another great opportunity. So that's another asset class which we consider very attractive for trustees to consider. There are many other forms of ETFs that can come to the market. Today, it's the most popular asset class in the market. So if you, instead of taking an exposure in a stock directly, you can buy an indexed fund, you can buy a fund that is tracking a certain basket of maybe large cap stocks. And so these are going to be created in time, and they're going to be very, very popular. The third asset class under the alternatives is derivatives. Now, we introduced this market in 2019, and the primary goal of this market was to help pension funds get hedging opportunities for their portfolios. So for instance, if you have invested in shares, and you want to protect the possibility of that share price coming down, you're able to buy a contract that protects that hedging, that side. It's called hedging. If you have a stock, let's say you have Safaricom, you're able to buy a Safaricom sell contract that protects the downside. So when the value of Safaricom goes down, the value of your contract is appreciating, and hence you're able to reduce the loss exposure. We are telling trustees, don't let yourself be exposed to the volatility without a way of protecting or mitigating that volatility. It's a very simple tool. It works very well. We think it's a great opportunity. You have opportunity of hedging, and you have opportunity of also selling those contracts actively in the market. And there are also opportunities of making money. So we feel that these are good alternatives for you to consider. And we want you to really engage with us, engage with your fund managers, and open the door for them to achieve that. Then we also have an opportunity to help trustees access non-listed opportunities or non-listed stocks. So we've developed a platform called the Unquoted Securities Platform, where today, if you want to buy into a company that is not listed, you can actually come to that platform and be able to buy that share. This gives you the entry of becoming part of a company before it's listed in the future, and helping you potentially get the benefit of better gains in the future. So we have already got two assets in our quoted securities platform, the Econ D-REIT and I-REIT. We have got companies who today have issued shares in the private market but don't have an access to the platform. That is one that we are providing. So those are the alternatives. I think it's a great opportunity for trustees to consider. And I believe that there's better wealth creation in the capital markets. We are doing well. I think there's a lot of discussion or conversations about strains in the economy. I must say that the market is very defensive. The markets are appreciating. You're seeing this good activity in the market, and really it's an opportunity for you to come in. So Simon, I want to possibly pause there and allow your clients to engage with me. Thank you very much.
Thank you so much, Jeff. Very insightful, thought-provoking contributions that you've made there. And I'm sure our audience has listened and followed keenly. And we appreciate the great job that you're doing, unlocking the capital markets potential in our country, enhancing economic growth sustainably, and enabling Kenyans to become rich so that they retire with dignity. And that's really a commendable job. We also appreciate the innovative products, the alternative asset class that is also creating value within our pension sector. So because of time, I think, Bansi, you can guide us next.
Thank you so much, Mr. Odundo and Simon. I'll engage the participants. We have a gift that's up for grabs, an Enewealth hoodie. For those of you who've seen the hoodies, you know they'd be perfect for this weather. So I'd welcome two participants just to react to the presentations, either the survey outcomes or the presentation by Mr. Odundo, just to ask questions and to give their views. I see Gabriel's hand is raised. So Gabriel, I'll allow you to speak. I've given you the rights. Go ahead.
Thank you very much, and good morning, everyone. Indeed, this is a very fantastic session that we've had. My first reaction was, I'm very happy to see that there is an increase in uptake in the IDD. My thought was it's a bit risky for retirees to take that, but then it's really interesting to see. And then because IDDs, you're likely to make more money as compared to probably if you were to take an annuity. Now, that was in the first presentation. The second one, I must appreciate Mr. Odundo. They're doing a great work at NSC, as Mr. Simon has said. Mine was just to ask how one can then get into the ETFs that he has mentioned, the electronic traded funds. Probably some of us are interested in taking positions with the gold, so that, I mean, it's for me, it's an interesting space to probably position ourselves. Back to you, Bensi.
Thank you so much, Gabrielle. Please just text me your number and we'll get in touch on how you can access your gift. I'll allow Mr. Odundo to answer that question. How do we get into it?
It sounds like accumulating gold for a golden retirement. And that's what, yeah, over to you, Jeff. Yeah.
Thank you very much. Yes, so thank you very much for that question. So for you to buy an ETF, you're able to get this by going to your stockbroker. The ETF assets trade on the exchange just like a share. So your stockbroker can acquire for you those ETFs. All you have to do is approach them. They'll take you through the valuation and the price of the ETF, and then they'll be able to acquire that for you. So it's the same way that you buy a share, nothing unique, but I think they'll give you a bit of education on how it trades and how you can also redeem the value and all the aspects of it. So it's a normal way that you trade. Just go and buy it like a normal share.
Okay, great. And another question for you, sir. Are there regulations on the REIT expense ratio? This has been asked by Kamau.
There are regulations that prescribe what percent of revenue is paid net of expenses. The guideline is that 80% of the total, 80% of the total collections have to be distributed to the investors. What the current REIT has done, it's paid over 90%, so only 10% goes to expenses. So think about it this way. If you were to have your own rental premises, you then have to collect the money, you have to do all the admin expenses, repairs, etc. Maybe you've employed somebody to oversight that. So you might find those expenses actually go to about 20%, or 30%. But if you're able to get into a REIT, you don't even get involved with how the rents are collected, the repairs, the maintenance, etc. All this is done by the REIT manager who are acting on behalf of the REIT promoters. So it's a very very easy, very less time consuming way to invest, and you get a guaranteed 80%. And this, by the way, REIT income is not taxable. So again, it's net. It's actually net return.
All right, great. Thank you so much, sir. We'll pick other questions at the end. I'd now like to invite Enewealth's General Manager, Mr. George Oyuga, who will just be further delving into the question of financial well-being. How can we support our retirees? And for us who are still employed or are still, actively working, what are some of the action steps you can put in place right now to ensure that we have a sense of financial well-being even in retirement? Karibu sana, George. You may get started.
Thank you, Bansi. Just confirm if I'm clear and audible.
Yes, you are clear and audible, and it's good to see that you're not a member of the Grey Hair Club.
No, I actually wanted to ask for where the application forms are, because I think my mirror has not been lying to me as well.
Bansi need to check carefully. He hasn't just checked carefully. He would notice he has some gray hair. Yeah, okay. Carry on, George.
Exactly. So I trust my mirror. Yeah, may I also take this opportunity to welcome all participants on board. Well, this is one of those research studies that really excited us as well along the journey. And as we looked at that, in our partnership with Strathmore, my work today will just be to do a partial review of the results, and the context that I would want to borrow is the context of looking at the financial well-being of these retirees in retirement. Now, key to note is that the data collected contained information on financial adequacy, as well as a measure of the level of life satisfaction of the respondents within the past 1 year. And that will be the basis of my invite today, as I invite you to this platform for us to have some meaningful conversations. The basis of this was to anchor on the impact of COVID-19. And we all know that COVID came in and it was an unforeseen pandemic, which no economy would say that they had prepared adequately for it. From the developed world to the developing to the underdeveloped, none of them. All economies struggled, businesses struggled, some of them shut down, actually a majority of them. Employees got laid off, reduced salaries here and there, amended contracts for some people. But key to note is that all these culminates to broken retirement journeys. And that's my biggest worry. But if we're to maybe put on some positive angle to it and ask ourselves whether there is an opportunity that presents itself with all these experiences, then I look at it as an opportunity for us to reset. And the call to reset in this particular perspective would be to actually invite us to have a relook at our basic policy framework around the retirement conversation. This is around how our benefits are funded, how they are invested, and expanding platforms in that area, and also how do we explore payouts that then would be able to give us the much desired retirement comfort and well-being, especially financially. So today, mine will just be to invite you that as we look at the findings there, then we'll be asking ourselves a key question around what do the findings really say? What's that inner voice that's speaking to us? And then from there, then we look at the proposed policy mitigations that we may be able to explore to mitigate on this today and also maybe going forward into the future. So part of the outcome of the research was that 57% of respondents reported other sources of income in retirement. Whereas this looks like some hustler survival mentality, I think for me, it points to something different. It points to these individuals having not attained the much desired income replacement ratio. And this means that when somebody's income replacement ratio is very low, that's why you'll find them at that particular advanced age, still trying very much to do farming, still trying to continue in business, still trying to secure some consulting jobs here and there. And therefore, that is something that we need to worry about, because it speaks to the question on whether is the retirement package or the retirement income sufficient, because we still see these retired people very busy with certain activities in the economy. So what's a mitigation that you can propose at this point? You who still has the space, the best thing would be to try and boost your income replacement ratio. And by this, we mean that your earnings after retirement would be at a comfortable level compared to the very last salary, for example, that you earned before you retired. And the recommended rate is around between 70-75 there would be comfortable for you, because even today what we earn, 30% of course goes into statutory deductions, taxes, and things like those ones. So then we'll be able to maintain our retirement lifestyle. Then the other mitigation would be to boost our retirement savings via additional voluntary contributions. The space is there, the infrastructure has already been laid, even within our different pension schemes. And this is to say whether you are in a corporate pension arrangement with your employer, whether you are in a business, SME, umbrella pension arrangement, or whether you're just an individual who decided to take charge of their retirement journeys by joining a personal pension plan. The infrastructure has already been laid there barely by the regulator, and we are grateful for that. Then the other thing again would be to choose the right retirement payout. When that time comes, you need to have known about pension, you need to have known about income drawdown, you need to have known about annuities, and maybe explore some non-cash retirement payout options, which I think, many people, of course, don't look at all that I've mentioned. Many people's eyes are always on the big check, which is what the provident funds have done. We've even seen some schemes agitating. They want to change from their retirement to a provident structure just because everybody's eyes on the lump sum at the end of the journey. And that is indeed dangerous. Another finding was that over 60% of reported an increase in their expenditure since the onset of COVID-19. What this tells me is also worrying, because that speaks to the fact that most of these retirees would actually have face the risk of inadequate retirement sources, yeah, as they retire. Because if you have already projected that your expenditures will be at this level, then a pandemic like this happens, then you realize that there is an increase in your expenditure. Then it means that whereas your income had already been at a particular level, then the chances are that you don't have room enough to be able to adjust. So how would we mitigate about this? Again, is keep your eye on the income replacement ratio again, at the same time, boost your retirement savings early now when you still have the energy and you can be able to do so. Then the other thing again is achieve some of the basic retirement needs outside the pension savings. This means things like building a house, do it before you retire. If it's a mortgage, finish it before you retire. Don't retire with loans. Don't retire still paying school fees. Maybe that calls for us to plan our families accordingly. And so some of those basic retirement needs will be able to tick the box before you cross over to the other side. Then it will not cause an impact or try and squeeze onto the little that you've already positioned for retirement. Another finding, which also found interesting, was the fact that there is a high elderly dependence ratio in Kenya. And that, of course, just tells us that, by the way, in that particular segment, age segment, many people are actually facing old age poverty, to a point whereby we even have government intervention to be able to give them something small at the end of the month. Pension can be able to do so. So take charge. It is you who will retire, not your employer, not your business, not the company you work for. It is you who will retire. So make sure you have a retirement plan. If it's not provided for within your work environment, then take charge and have a pension plan, personal pension plan. And we as Enewealth, we are all ears. We can guide you on this. And then on the other hand, again, is choosing the right retirement payout when that time comes. The other finding that I also found a bit interesting was that 65% of the respondents had taken mobile app loans and also had loans from commercial institutions. Whereas loans are good, but what I hear here is that people hardly consider the cost of borrowing. When we have more people borrowing from these mobile apps, of course, that thing they call interest in that space is not in your interest. It's actually the cost of borrowing, which you must consider. And some of those platforms are very expensive. So when I hear conversations around maybe a SACCO for retirees, then I get excited, because indeed, maybe that's a conversation we need to have. And even those who lend to retirees, for those who've already noted, a pensioner is one of the most secured people in terms of earnings, because this is a promise that they have been given that as long as they are alive, they'll continue earning. So whereas we even do loans as banks will do loans to people who are earning simply because they have a pay slip, at the end of the day, the lifespan, the shelf life of a pay slip is actually around 30 days, considering the what I call the contractual engagement. People can give 30 days notice, either party, the employer or the employee. But for a pensioner, there's no notice. They'll be earning that amount for life. So if there is a banker in the platform today, just consider that these are among the safest people to be able to lend to, so that they don't revert to those expensive platforms to be able to borrow. But as you do so, keep your costs of borrowing very low, and always check that your debt to income ratio is not above 50%, because that would then choke you. Another finding was that the level of life satisfaction for retirees is actually lower than the level expected of senior citizens. And this is a bit worrying, because it also asks us as stakeholders within the retirement sector whether our retirement structures, the way we've framed our conversations, the payouts and everything else, is actually addressing the desired purpose. And maybe it's a question we may need to look into as a part of the next study, for example, just a suggestion, that we try and see if our retirements are actually meeting the objective of why they were set up. because when they were set up, there was a desire that maybe we will replace income by this ratio, for example, 70–75%. But to date, we have converted those schemes from the defined benefits to the defined contributions. And what we are asking ourselves is whether are we still adequately addressing the purpose for which these schemes are being set up? Or is it just a matter of somebody has retired, they get their check, and we go and we don't assess whether they're actually meeting the needs that are there. So a savings platform that addresses other needs like medical, housing, and etc. is also good for retirees. And that's why even in our policies, we may need to look at considering non-monetary retirement payout options, for example. That one is in a scheme as they retire, the scheme tells them, here is the key to your house, here is your card for medical and the like. So enjoy your sunset years happily going forward. Another finding that I also found interesting was the fact that 41% of respondents used out-of-pocket cash to pay for their medicals. That tells me that maybe we are not doing enough when it comes to sensitizing people on the need to actually enroll into our post-retirement medical products that are in the industry. And Enewealth boasts having launched the very, very first one when this idea was already ripe within our market. So all pension stakeholders need to drive uptake of post-retirement medical, and the post-retirement medical should shift from just being an optional additional voluntary contributions platform to maybe something that is structured within the scheme structure so that it is a mandatory scheme contribution rate. When we say we are doing 10%, we know that 7 is going to my savings and 3% is going to my post-retirement medical pot. Because with this positioning as additional voluntary contributions, I think will take a long time to struggle, yet the realities, even based on this study, are actually evidently there. So what this points out, all these, and together with many other research findings that I could cite, in the interest of time, is that there are risks in retirement which we must be awake to. The liquidity risk is there, the medical risk is there, the longevity risk is there, as well as the social risk that is also highlighted in that. So that calls me to maybe try and demystify some of the retirement myths that many people have. Some say I have a long way to retire before I retire. Others say my children will take care of me when I retire. Others say I will not need a lot of money when I retire. Others say my children will get very good jobs after school. There is no way my friends will allow me to suffer. They'll take care of me. That thing you guys are calling inflation is a myth. I am okay as long as I save at the rate set by my scheme. I don't need to do additional voluntary contributions. My employer has not set up a scheme, so therefore I cannot save for my retirement. I will start now. I will start, but not now, maybe later when I'm a bit older. All these things, and given time, we can demystify all of them. So if you're thinking in any of those angles, allow me to just give you a stamp of all these are myths and the reality is far different from what you see there. So as I finish, my question to you would be, based on what you've had today, how prepared are you? Are you funding your retirement journey adequately? Are you optimizing on the investment options, including the new things that the CEO NSC has already given us or highlighted? And do you know what your right payout option would be when that time comes? So let me leave it there and say thank you very much for the opportunity. I know we are available as Enewealth to engage further on any of these findings. I saw somebody asking where can they get the full report. Indeed, just get in touch with us and we'll be able to share the same, and feel free to engage. Thank you very, very much, and over to you, Bansi. Thank you.
Many thanks, George.
Powerful. And thank you so much for a very insightful presentation. Bansi?
Thank you, George. And the parting shot and the questions were very eye-opening. Gabriel says that this was very mind-opening. Thanks, Gabriel. So we'll go over to the last presentation, which is by our boss in the industry, RBA CEO, Mr. Nzomo Mutuku. But before Mr. Mutuku talks to us about issues regarding the retirement benefits and how we've readjusted since the pandemic. I'd be very interested to know how many of us are experiencing the signs of joining the Gray Hair Club, the infamous club that has just been launched in this webinar. So wale wako ndani, let us know.
We form a Gray Hair Financial Services Limited. Yeah.
Yes, and you'll continue as CEO.
Nancy, even my hands are raised up fully.
Okay. Let's launch the poll so that we can have our industry polls coming on.
Yes. So I'll end the poll. I think from this group that has joined us today, majority of us are approaching retirement or probably in retirement. So it's good to see that you're still engaging, and hopefully you're learning more about how you can readjust in this COVID season. So without further ado, I'd want to welcome Mr. Nzomo Mutuku. Thank you for staying along and your patience. We are eagerly waiting to hear from you. Karibu.
Thank you.
Thank you. Thank you, and good morning, everyone. I hope you can hear me well.
Yes, we can.
Good. And let me just confirm that I'm the founder member of the Gray Hair Club. I've been there for a while. In fact, Simon, when you are saying that you checked your statement, I also had to check my statement, because I think amongst us, I'll be the first one to to be going there. So, and I think that advice that we have just been given by George about how prepared we are, I think I've really taken it to heart, because I'm certainly in the front line of those who are going to retirement. So anyway, thank you, Enewealth, for organizing this, and thank you, Enewealth and Strathmore, for carrying out this important research. Let me acknowledge Jeff Odundo from NSC, and thank you for showing us the alternatives that you have. And let me just tell the participants that all those alternatives that Jeff talked about, we allow them in our investment guidelines. In fact, we are ahead of Jeff, because some of the products he has not yet launched them, but they're already allowed in our guidelines. So when they come, we are ready. So we know we have ETFs, you have derivatives, you have REITs, all those things they are there, and the pension schemes are allowed to invest in them. So thank you for that, and also thank you to George, like I said, for giving us that perspective of preparation for retirement and well-being in retirement. So I think it's a pleasure for me to be here and speak to this distinguished assembly. And we really appreciate the fact that this is a talk about something which has been researched. As RBA, and perhaps because of my background as a researcher also, because I used to be in research for many years, we really appreciate research. And for us, when we make policy recommendations, we always want to make policy recommendations based on solid research and facts on the ground. So as RBA, we do a lot of research ourselves. We have done similar surveys. We do pensioner survey. Perhaps one point of departure is that ours, we even interview those who retired long time ago, as well as those who have retired recently. But we also do a lot of other researches which enable us in our mandate of developing the industry and advising the cabinet secretary on policy matters. So every year, actually, based on the research, we submit what we call the budget memorandum to Treasury with proposals for various policy changes. We have seen a few have come in the finance bill, which has already been published. So we are happy with that. But we shall know about whether others have been adopted. I think it's on June 8th, 8th or 10th, when we'll be having the budget speech. And of course, that's when also the changes to regulations and other things will be published. So research is very critical, but more importantly, the topic that we have on the effect of COVID on financial and well-being of retirees in Kenya is extremely relevant and timely, coming at the time when we are in this pandemic. It has meted out unprecedented human, economic, and social costs, and it's also been quite persistent. So, these findings will still be relevant going forward because some of these issues are still with us, even as we see some recovery. I think it has been well said, the impact on the global economy. We saw the global economy contract by 3.5% last year. We expect at least some positive growth this year. Here in Kenya, as we are waiting the final economic survey with the final growth for last year, we do know that the last few quarters had even negative growth. The second and third quarter had negative growth. We saw the markets, including the NSE, affected by the pandemic. So it has been a tough time for us in the retirement benefits industry. As we have heard, we had people who are retrenched. Some of them have been participating in this survey, and we have seen how they were impacted. We had others who had to go on unpaid leave for some period and then come back. We had others getting salary cuts. We had employers who are forced to suspend contributions for some time. We are happy to see many of them have come back. Especially we had, for example, schools, we had hospitals. Those ones have now come back and they are contributing. A lot of the hotels which reopened have come back and they are contributing. Restaurants have come back. Perhaps the areas which are still struggling are airlines and some of the other hotels in the more specialized areas which rely a lot on tourism. But those that relied more on local business, at least we are seeing them coming back to contributions. So all these shocks hit our industry. Of course, there are shocks on the investment side as well. And we saw, our risk score, because we use the risk-based supervision, we saw the overall risk score of the industry moving up for the first time since we introduced risk-based supervision. Over the years, it has been coming down. But for the first time, it has gone up a bit as schemes were getting these shocks. But despite that, I think the industry was quite resilient. Let me just share with you some statistics. For 2020, our assets grew from 1.29 trillion to 1.39 in December 2020. So that's around 7.7% growth for assets under management, as compared to around 11.3% in the previous year. We saw schemes increasing exposure in certain areas, particularly government securities and guaranteed funds. So, for example, government securities, if we go back to 2018, we had around 39% of total assets there. In 2019, it was 41%, and now it's 45%. So you can see that growth of around 6% over 2 years. Equities, Jeff, has come down from 17.3 2018, around the same 2019, and now 15.5. Real estate has also come down from 19% in 2018, 18 in 2019, and now 17 point something. Guaranteed funds, like I said, is up 14% in 2018, 15, 2019, now 16.5. One area which has really gone down is the listed bonds, and this is because of what we've seen in the market, where a lot of the bonds have matured and we have not seen new issues. So this used to be around 3.5% in 2018, but now we are down to 0.4%. Just to touch on one of the issues that Jeff raised, the REITs, this has also come down a bit from 0.06 to 0.02%. But on the other hand, the private equity has gone up from 0.07 in 2018 to now 0.12%. So yes, we have seen those shifts, but we are still seeing overall growth of the industry. So coming back to the research, and I don't want to repeat because I think the analysis of the findings has been very thorough. But just from my perspective, there are a few things which I picked up which are very interesting. We are very happy to see that income drawdown and post-retirement medical funds have really picked up. That's great. Those are new innovations that we brought along the way, and we are happy that they are picking up. That's very good. we'd want to see more. I think there was a slide which showed where people are using their money. And I think the top was on school fees, and medical was around number 3 or 4. But if you do the same survey of those who have retired much earlier, you find that medical has moved up to become number 1. People have just retired. Of course, their children are still young, they're still in school, they have to pay fees and so on, and they're still quite healthy. But over time, you will find a medical taking over as number 1 expense for retirees. So to hear that a good number of them are getting insurance, that's great to hear. And so that they can be supported in this medical, which is going to be a big issue for them going forward. It's also interesting that a lot of retirees have invested in real estate, because I saw rental was the number 1 alternative source of income. So Jeff, you need to do a bit more work so people can invest in shares and bonds and other areas. They should not put all their eggs in the rental basket, because as we saw with COVID, sometimes those rentals are not there. The tenants are either not able to pay, or they have to move out because they are in problems. So it's good to have diversified portfolio and have more in the market, I think, as retirees. I was very happy that one of the questions you asked in the survey was on mental health. This is something that I have to say, even in our previous surveys, we have never touched on. So it's good that this is now coming to the forefront, and that we are now interrogating what is the mental health and general well-being of these retirees. We can be focusing so much on financial well-being, and yet they're having other serious challenges, psychological and so on. So that's great. Thank you very much for that. And I think it's something even us will take on going forward as we do more research. So I think apart from post-retirement medical and income drawdown that we have introduced, another new one that is coming, of course, the one of mortgage. And just to say that we did the regulations which were gazetted, and we did give schemes a period of 1 year to implement, which is ending sometime in September, so there's still some time. We have seen a few applications coming here, but we realize we need to help the schemes. So what we are doing is we are coming up with a template to help schemes to know how to make these amendments. So in the next 2 weeks, we're going to invite trustees and others for our function, where we'll just go through that template, and then we'll make it available, on our website and so on. Because we know schemes are having a lot of challenges in making these changes, yet the members themselves are very keen, and they're putting a lot of pressure. So we just want to assist, and just look out for that. We shall be calling you. For that. And of course, you saw one of the expenditures which was there was rent. So if you can have people getting houses so that they don't have to pay rent when they retire, that would be great. So maybe as I conclude, just to reiterate that for us in RBA, we are still confident of achieving our goals in our strategic plan. You'll recall our goal is to take our assets to 2.4 trillion. So we have 1 trillion to go before 2024. So we are going to have to see a very sharp increase in the growth rate to achieve that, but we are confident that we shall do so. We believe the industry will bounce back very strongly, and we shall still be able to achieve that, driven both by investments performing better, but also more people coming into the system, more people saving for retirement, and therefore we are generating more. And one of the lessons of COVID, of course, is that those who had retirement schemes had a cushion, because when they were retrenched, you saw the statistics there. Those who were retrenched when they were still below 50, for example, they were able to go and get out 75% of their money, and you can see they did it, and that helped them a lot in those difficult times. And those who were, maybe closer to retirement were able to get a 1/3 out. But those who didn't have any kind of pension scheme at all, they didn't have this kind of cushion. So I hope this is a lesson that Kenyans have taken, so that as we go forward, they see this is one of the many values of saving for retirement, on top of all the other great values that we have, including the tax incentives, including the very solid regulatory framework as compared to other forms of saving. You saw the other day people losing their money in some pyramid scheme, which was being called Amazon or something like that. People are putting money in the wrong places. People should put their money in regulated space, such as in pensions. And then we have all these great value additions like the post-retirement medical, the mortgage, income drawdowns, and so on that we have talked about. So the case for saving through pension schemes is very strong, and I believe Kenyans are becoming aware of that fact. And that will help us to achieve our target of 2.4 trillion, as well as our coverage of 30% of the labor force, up from 22% today. So as we come to the end of this financial year in June, we are going to be closing our 20th anniversary. So we still have a couple of events. We have had to postpone some, but as industry players look out, we shall be calling for you for a couple of events before June 30th, just to commemorate the 20th anniversary of RBA. So thank you very much once again for inviting us and for this very good research. And we look forward to continuing to engage as we try to develop and strengthen our industry. Thank you.
Thank you, sir, for the presentation that you've made to the industry, and grateful for very in-depth perspectives of the status of the sector. And this is key for us because we are stakeholders in the sector, participating effectively in enabling our sector to achieve also the regulator strategic goals. Bansi, over to you, I think, towards the end, you as our moderator.
Yes, thank you, Simon. We're approaching the end. I'll allow a few of the attendees to ask the questions live. So if you have a question for any of the panelists, just raise your hand and I'll allow you to speak. Anthony Musumba, please go ahead, unmute yourself and ask your question.
Thank you very much, Bansi. My question actually is directed at Enewealth, how you administer the pension. I retired like 2 months ago from National Drought Management Authority, NDMA, and also I'm happy to note that the person who processes our pension, Mr. Boaz, is also in attendance. Now, I wanted to know how long it takes to actually process benefits, in that I'm quite sure that all the documents from NDMA have been forwarded. And I think the contact person should be Stephen or Eric at your end. And I've tried to also put in some communication through email, but unfortunately there's never been any response. As now this webinar is actually addressing the effects of COVID-19, and to be honest, it is hitting me hard in that now I don't have any salary, my pension is delayed, and I wouldn't like to have a broken retirement journey. So please, maybe you could give me a response. Thank you.
Thank you,
Thank you so much, Anthony, for that raised concern. We will pick it up with the responsible parties to ensure that is resolved. We'll check it out with the NDMA and give you feedback before today.
Thank you, Simon. And Anthony, we wish you a happy retirement. Patrick, I've allowed you to speak. You may ask your question.
Actually, it's not Patrick. I am using his link. My name is Vincent.
Yes, Vincent.
I work for Christian Health Association of Kenya.
Uh-huh.
I in the gray hair club. So I turned 50 this 1st of May.
Oh, congratulations.
And, so my thing is that I would like to retire at the end of the year. So because I would like to have to disengage with the organization at the end of the year. But the thing that I'm interested in is to have that if like now I can continue with the medical schemes and all those things so that I can be able to have a positive life, because I believe that I'm going to go to one like Jojo. So I have another 50 years to live. My question is, how does Enewealth help me with I have other things that I do so that I'm comfortable in life as I continue? Because I believe that now when I have a relationship with Enewealth, it can be able to help me to be a better person than it has been having with my pension.
All right, thank you for your question. I'll pick any other question that we may have. If you have a question, just use the raise hand icon and we'll unmute you. In the meantime, we see a comment on the Q&A. RBA is doing a great job as regards to financial well-being and income replacement ratio. Can RBA expand pension relief from 20K to 40K? That's a good suggestion, which you've tabled. There's Jonah who's asking, can pension funds whose sponsor is insolvent join or merge with a sponsor? And they're also asking whether there's a mechanism for pension schemes to insure themselves against risk. So I'll allow Mr. Mutuku to respond to those two questions. And then
thank you. Thank you, Bansi. Let me respond to those and also comment on the retiree. Yes, 20K to 40K. Actually, that's one of the proposals that we submitted this year. I think the figure we had was not 40, it have been 36. We did propose that relief be increased from 20K to 36. And that was in line with the increase that we have seen in personal relief. You'll recall that when the Tax Amendment Act, which was mentioned earlier, came, there was some relief which was given, and then some of them were reversed, but one of them which was not reversed was the personal relief. So we are thinking that that should also apply to the pension. So we agree, and that's one of the proposals that we have made. We hope we'll see that being taken. A sponsor who is insolvent, this is a question which is really at the heart of our system. You know, the reason our system has the scheme as a separate legal entity, which is basically under the Board of Trustees. One of the reasons is exactly this, so that if the sponsor becomes insolvent, the scheme is still there and people can still get their benefits, even though the sponsor is long gone. You know, and even the checks and balances we have, where we have custodians and all this separation of roles, is to make sure that the assets are separate from the sponsor. But if the sponsor goes, the scheme can still pay the benefits. So yes, there are various options. Sometimes schemes are liquidated, and if the people have not reached retirement age, the money can be transferred to other schemes of other sponsors, including IPPs like the Enewealth IPP, or umbrella schemes and so on. And that option is there. And there's also an option of, you know, the whole scheme just moving into an IPP or an umbrella scheme. So yes, insolvency of sponsor should not be a problem for the members, at least up to the date. Of course, going forward, now they'll no longer have an employer, but up to that date, their money should be safe, and there are many options, including transferring to other schemes. I think just on retirement, and you know, the comment on living to the Jonjo age of 101, you know, that reminded me of something from the survey that a lot of people are going for income drawdown. And I think it's good to caution that, you know, annuity is a very good product to insure you against very long life. You know, income drawdown is normally quite finite. You know, you can take 10 years and you keep extending and so on, but it's important to balance between the two. So I always advise people, you know, you can take the drawdown, but it's also good to have an annuity, because annuity ensures that if you live to be 101, you know, that you'll still be earning that money from the annuity. On the other hand, the drawdown, it can be exhausted after some period of time, depending on how you structure. So it's always good to balance these different types of pension products, just like it's good to balance even in your investments and not put everything into one basket. So those will be my responses to those questions. Thanks.
Many thanks, sir. Simon, I'd want for you to just answer a few of the questions.
Thank you, Bansi. I think we have a couple of questions on the chat. Some of them relates to NSC, and I'm sure perhaps Jeff could respond to that. Unless Bansi, you could pick out some that are specific, I can answer.
Okay, yeah. Thank you. So I'd want to direct this to Mr. Odundo. What's the minimum requirement for getting a REIT, and how much does it cost?
Thank you. So today, if you want to acquire a REIT investment in the market, the current one that's listed is trading at a price of about 6 to 650. That's 6 shillings and 50 cents. And again, this you also buy through the broker. So it's you just buy just like a normal equity. You place your order, they're able to acquire for you that. So it's a normal transaction that you normally do. So that's the value today. We hope to see more coming in. And by the way, at 6 shillings and 50 cents, you're investing into an asset whose net asset value is about 20 shillings. So you're actually getting a very huge discount. It's very discounted at the moment. And so you're really buying into a profit. Thank you.
Okay. Thank you so much, sir. Nangila?
Okay, just to note, two people asked about the government increasing the state pension and why we shouldn't go the Turkey way. But I'd like to say that in as much as government can help by increasing the state pension, it's solely the responsibility of individuals to plan for their retirement. We may have a couple of vehicles, like we know that we have NSSF, for example, but even at the point of retirement, that in itself is not enough. And also, if we consider pesa za uzeeni that people get occasionally, it's not enough to sustain the needs of individuals in retirement. So it is upon individuals to take up the responsibility of planning for their retirement. Thank you.
Many thanks, Lydia, for picking that up. Ladies and gentlemen, I see we are 2 minutes off, and we must bring this to a conclusion. So in closing, Enewealth is very passionate about supporting policy formulation and just offering authentic data-driven solutions that will support our members now when you're working and even into retirement. So this is the 6th of our study. After the webinar, we will send you a link to all the reports. Feel free to just dig in and get some information that could be helpful in the future. Finally, I'd want to acknowledge the team that has made this day possible. We have Mr. Gift Mbeja in absentia. We have Peor Makoha, Lydia Wamalwa, George Oyuga, Simon Wafubwa, and myself, Bansi Kaleli. We are very interested in extending this conversation, especially with the trustees of the various schemes we serve, and to see how they can put in place measures within their respective schemes that will be for the benefit of their members. And to that end, we have planned our 4th annual Trustees Forum next month, in the month of June, from 16th to 19th June, where we'll be talking about taking stock and the future outlook. What is it that the trustees of the funds that we serve, that we belong to, need to do such to ensure that we are all retiring, well informed and having saved enough to take care of our retirement needs. So that's it for me. I'll invite Simon to give his closing remarks, then we'll get.
Thank you, Bansi. First and foremost, I wish to thank the CEO, Retirement Benefits Authority, Mr. Nzomo Mtuku, for graciously being available on this forum and sharing very insightful information that is relevant to our members and trust that we serve. Number 2 is to thank Jeff Odundo, the CEO NSC, also for making time, and also Naomi from Strathmore University for immense contribution in this partnership, and also the team from Enewealth who have tirelessly worked together to get this research out. We wish all our stakeholders all the very best, and we reiterate our commitment to exemplary service to our members and ensuring that we uphold the highest standards of ethics and integrity while serving our members. Thank you all, and we wish everyone all the very best. Just in case you're wondering whether you'll get the materials we've shared today, yes, the answer is yes. The recording and the presentations are going to be shared through email. With that, we come to a close. And once again, thank you and have a great afternoon.
Thank you, Simon. Have a good afternoon.
Thank you. Good afternoon.
Thank you. Good afternoon.